A steady paycheck used to feel like protection. Now it often feels like temporary stability with hidden risk underneath. You can earn consistently and still feel exposed to volatility in everyday life. You work 40 to 60 hours every week. The salary arrives on schedule, predictable, and clean. Yet the feeling of security fades faster than the pay cycle resets. Promotions increase your income on paper. At the same time, rent, insurance, and groceries quietly compound in the background. The target moves faster than your raise adjusts to inflation and time horizon realities. When progress feels slow, many people blame themselves. They assume the problem is discipline, hustle, or not investing early enough for compounding. But sometimes the drawdown is structural, not personal. This is the margin. We examine the math behind risk, wages, and the modern cost of living without hype. Today, we redefine what financial security really means in the long term. For decades, security meant having a permanent job. You showed up, worked hard, and expected stability in return. That story shaped how most of us understand risk and time. The old model was straightforward. Hard work was exchanged for predictable progress. Time felt like an ally, supporting long-term compounding instead of creating volatility. Many families bought homes on a single income. Tuition did not distort the long-term risk equation. Debt existed, but it was not the default starting point of adulthood. Companies once valued long-term loyalty. A 20-year career in one place was normal, not unusual. Career risk and drawdown felt limited within a stable structure. Security felt systemic, not personal. Wages generally moved with economic growth over a long time horizon. Expectations aligned with reality and volatility felt manageable. The problem is the system evolved, but our mental model of security did not update at the same speed. We are applying old assumptions to a different risk environment. Modern companies prioritize efficiency. Quarterly earnings shape decisions more than individual stability. Personal income now carries more volatility than before. This shift is structural, not personal. The system is optimized for capital efficiency, not employee protection. That design changes how risk is distributed. At this point, income alone is not true security. The source itself can experience drawdown without warning. That is the quiet risk many people are beginning to notice. Today, many workers live paycheck to paycheck. Even with salaries that look reasonable on paper, nearly 60% of American workers struggle to save, which quietly increases financial risk over time. Student loans remain in the background long after graduation. Credit card balances revolve with quiet volatility. A car loan becomes a necessity, not a luxury, compressing the long-term time horizon. The issue is not only spending habits. The structure of modern costs is increasingly fixed and inflexible. Most income is locked into obligations before it has time to compound. Rent alone can take 30 to 40% of income. Health insurance may cost hundreds each month. Transportation and essentials quietly reduce any buffer against volatility. When one income stream stops, the system shakes. There's little buffer for drawdown. Time becomes the biggest pressure. You may not be poor, but you are not fully secure either. Those are two very different risk positions. A promotion feels like progress, yet lifestyle inflation quietly absorbs the raise. The margin does not expand as expected. Higher income often raises social expectations. The environment resets your definition of normal. Without noticing, your long-term margin gets thinner. When margins thin, anxiety appears. Not because you are lazy, but because your structure lacks resilience against volatility. Modern work systems often create single-source dependence. One job becomes the primary engine of survival. That concentration of risk is something we quietly normalize over time. When layoffs happen, it feels deeply personal. But most of the time, it is a spreadsheet decision about efficiency and volatility. Numbers tend to outweigh loyalty in modern corporate math. The old idea of security was built on stable systems. You stayed loyal, and the system protected you over a long-term time horizon. Today, stability is no longer the priority. Corporate flexibility increases shareholder comfort. But for workers, that same flexibility means income volatility and potential drawdown. Volatility is not the same thing as security. Many people are working harder than ever, but they are working inside a system that changes faster than their expectations. That mismatch quietly creates burnout over time. A high income can look impressive on paper, but cash flow alone does not eliminate risk or shorten recovery time after a shock. Income is a stream, not a foundation. Real foundation is measured in time without income. It is the ability to absorb volatility without panic. It is positioning yourself with a longer time horizon. Without that foundation, even a large salary can feel thin. Thin margins create mental pressure, and pressure reduces clarity and long-term decisions. This is why many professionals feel stuck despite earning more. The issue is not just income level. It is the absence of structural security in a volatile system. Modern security is no longer about how big your paycheck is. It is about how your life is structured around risk and time horizon. That shift is quiet, but it changes everything. Security starts with time, not income. How many months could you survive without a paycheck during volatility or drawdown? That number is more honest than any salary headline. The second layer is cost flexibility. If your expenses are rigid, your stress becomes rigid too. Stability improves when you can adjust quickly without panic. Third is income resilience. One large paycheck can disappear faster than expected during market volatility. Two moderate streams can reduce personal drawdown risk over the long term. Fourth is owning productive assets. Assets that compound quietly without your constant presence. That reduces dependence on a single source of effort. This is not about getting rich quickly. It is about reducing personal systemic risk over your long-term horizon. That approach is quieter but more durable. Many people chase higher income. Few people measure their margin after expenses. Margin is the quiet buffer that absorbs volatility. When margin expands, anxiety tends to shrink. Decisions become less reactive and more rational. You start thinking in compounding terms instead of survival mode. Security is not a milestone salary. It is a structure built slowly over time through compounding decisions. And unlike income levels, structure can be designed intentionally. If you feel behind, you may not be failing. You might simply be using an outdated playbook. Meanwhile, the rules quietly shifted around you. Income still matters in a long-term plan, but it is only one variable in a larger risk equation. When you focus on salary alone, you ignore volatility and time horizon. Modern systems reward efficiency. Companies optimize for lean operations and predictable output. Individuals, however, survive through resilience during drawdown periods. Security is part mathematics and part behavior. Numbers without discipline erode over time. Discipline without structure collapses under stress. Most financial advice sounds simple. Spend less and work harder. But complexity in wages and living costs has increased beyond slogans. A more mature approach is intentional design. Think of your finances like a business managing risk exposure. That mindset changes how you view compounding over a long-term horizon. We cannot redesign the global system. Interest rates, markets, and policy cycles move beyond our control. But we can adjust our position within that volatility. When your position improves, anxiety often declines. Not because income suddenly doubles, but because your structure absorbs financial shocks more smoothly. Real security feels quiet. It acknowledges risk without panic, and it prepares for drawdowns before they arrive. Young adults are entering a very different economy. Housing costs have grown faster than wages for years. Global competition quietly increases pressure on income stability. Technology boosts productivity across industries. At the same time, it increases job volatility and shortens the time horizon of many roles. Progress and uncertainty now move together. AI and automation accelerate structural change. Skills that once felt secure now face faster obsolescence. Stability becomes something dynamic, not permanent. In this environment, static security is harder to maintain. Adaptive security requires margin and flexibility. Without margin, every shock feels like a drawdown. Many people chase a lifestyle that looks successful. Fewer invest time in foundations that compound quietly. But foundations determine long-term resilience. A house, a car, a vacation are all valid goals, but prioritizing them without margin increases financial risk. The order of decisions shapes your long-term volatility. Security is not about looking established. It is the ability to withstand market volatility without panic. That standard feels quieter but far more durable. This new standard is rarely glamorous. It does not create viral moments or flashy signals, but it quietly reduces long-term risk exposure. The future belongs to people who understand structure, not just those who chase income milestones. Understanding systems creates smarter long-term positioning. Ask yourself something uncomfortable. If your income stopped tomorrow, what would actually happen? Not the optimistic version, the real math version. This is not about fear. It is about measuring structural risk in your life. Clarity is the first step before any long-term adjustment. The answer might feel heavy. You may realize your margin is thinner than expected. Awareness often feels like a small emotional drawdown. But this is where design begins. You can calculate your real breathing room. Small adjustments reduce volatility over time. Security rarely comes from one big leap. It usually comes from consistent, boring decisions. Compounding is quiet, not dramatic. Every dollar that strengthens your buffer reduces future risk. Every expense you control lowers potential drawdown. Maturity is choosing stability over appearance. You do not need extreme wealth to feel secure. You need a structure stronger than short-term volatility. That shift changes your time horizon completely. When thinking changes, strategy follows. Income becomes a tool, not the identity. Long-term design replaces short-term pressure. Real security feels quiet. It is not a viral milestone. It is a solid foundation that survives volatility. Income still matters, but it is no longer a guarantee of stability. In a system shaped by volatility and rising fixed costs, salary is only one variable in the equation. Security today looks different than it did a decade ago. It depends on margin, flexibility, and how you manage risk across your time horizon. The math is less emotional but far more honest. If this made you rethink your situation, that is the point. Not to create fear about drawdown or debt, but to clarify structure. When the numbers are clear, anxiety tends to shrink. When you understand the system, you stop reacting to every headline. You start thinking in long-term positioning and compounding behavior. Design replaces panic. This is the margin. We break down the uncomfortable math behind income, volatility, and long-term trade-offs. If you want calm clarity about money systems, we will see you in the next video.